Look at this! It's bleeding! I didn't even buy that $15 weapon skin.
You checked your bank account last Thursday. The number was lower than it should have been. You did the mental math. Rent, utilities, the usual expenses, nothing extraordinary. No surprise purchases, no unexpected bills. And yet, somehow, the balance didn't add up to what you expected. That vague sense that money is moving faster than it used to. That feeling of treading water despite doing everything the same way you've always done it. That quiet suspicion that something is happening, but nothing specific enough to point at. You're not imagining it. What started in late February 2026 has set off a chain reaction that most people won't fully understand until October, maybe November. By then, they'll have forgotten what caused it. They'll stand in the grocery store, stare at a receipt that seems impossibly high, and assume they must be bad at budgeting. They're not bad at budgeting. They just don't know what's coming. Right now, most people are staring at the gas station sign. $3.70, maybe $4, depending on where you live. They're filing it under annoying but manageable and moving on with their day. That filing is wrong. And the cost of getting it wrong isn't dramatic. It's quiet. It's a grocery bill that keeps creeping up with no obvious explanation. A summer flight that somehow doubled. A mortgage rate that was supposed to come down and didn't. A credit card balance that never quite shrinks no matter how many payments you make. This video breaks down exactly what's happening, why you're not ready for it, and the specific moves that separate people who come through economic disruptions stronger from people who come through them weaker. Let's get into it. To understand why your bank account feels lighter, you need to understand the timeline most people are missing. On February 28, 2026, the United States and Israel launched coordinated airstrikes across Iran. The geopolitical details will be debated by historians for decades. That's their problem. Your problem is what happened in the weeks since Iran retaliated. Oil infrastructure took damage. By early March, the Strait of Hormuz, a 21-mile bottleneck that carries roughly 20% of the world's seaborne oil supply, was effectively closed. For the first time in history, commercial vessel traffic through the strait dropped to near zero. Normal traffic is 130 ships per day. The International Energy Agency called this the single largest energy supply disruption ever recorded. Larger than the 1973 OPEC embargo, larger than the 1979 Iranian Revolution shock. They released 400 million barrels from emergency reserves, the largest release in the IEA's history. That's not a routine adjustment, that's a fire extinguisher. Brent crude went from $71 per barrel to a peak near $120 in weeks. It's pulled back to around 100 on ceasefire signals, but if this drags beyond 6 weeks, analysts project $150 per barrel is on the table. The gas price you're staring at is wave 1, but this isn't one price spike. It's 5 separate shocks rolling toward your wallet on 5 different timelines, each one bigger than the last, each one disguised as something completely unrelated by the time it lands. The first wave is the one you can already see. Gas. The national average has jumped from under $3 to nearly $4 per gallon. In California, drivers are paying over $5.50. Diesel, the fuel that powers the 18-wheelers that deliver literally everything you buy, has surged over 40% to nearly $5.40 per gallon. Here's why diesel matters more than the gas in your car. Diesel powers the refrigerated trucks, the farm equipment, the freight trains, the entire physical supply chain. Every cent diesel goes up translates directly into the cost of things it moves. This isn't theory, it's documented, predictable, and already happening. A $1 per gallon increase in gas prices removes roughly $150 billion in annual consumer spending from the economy. The average household is now looking at $750 in additional fuel costs this year.
Just $750? I can cover that by not buying those $15 cosmetic armor upgrades.
For most people, this registers as annoying. They file it under temporary inconvenience and wait for things to normalize. The problem is, this wave isn't alone. And by the time people realize that, waves 2 through 5 will already be in motion. Which brings us to wave 2, groceries. This one lands in 30 to 60 days, and it's already started. You just can't see it yet. Diesel doesn't just move cars, it moves food. Refrigerated trucks deliver everything perishable on a schedule that doesn't allow for stockpiling. You cannot warehouse fresh avocados for 6 months while you wait for fuel costs to stabilize. When diesel rises by $1 per gallon, freight carriers pass 60 to 80% of that increase through within 30 to 60 days. Before this conflict, grocery prices were rising around 2.5% per year. Economists now project consumer price inflation climbing to 4.5% in coming months. Poultry and dairy were already projected up 6 to 10% in 2026, olive oil up 8%, cocoa nearly 12%. Now layer a 47% diesel spike on top of all of that. Retailers will absorb what they can, but the cushion is gone. By May, you'll stand at the checkout with a total $50 or $60 higher than expected. You'll wonder if you somehow bought more food. You didn't buy more food. The food just costs more. And nobody will announce this. Wave 3 is the one that should genuinely concern you. By the time you feel it, you'll have completely forgotten what caused it. This is the fertilizer wave, and it's set to land in October. Natural gas is the primary raw material for nitrogen fertilizer. Fossil fuels account for 70 to 90% of the cost of producing what farmers put in the ground to grow basically everything. Roughly a third of the world's seaborne fertilizer trade passes through the Strait of Hormuz, which is closed. Granular urea jumped 50% in weeks. At import hubs, fertilizer retailers have stopped quoting prices because they can't guarantee delivery. Here's the timing issue. Spring 2026 planting is happening right now. The decisions farmers are making this month determine the fall harvest. The fertilizer prices of March 2026 become the food prices of October 2026. You won't feel this wave in April. You'll feel it in October, standing in the produce aisle, convinced you must be doing something wrong financially. Nobody will connect it back to a military operation 7 months earlier. The cause and effect will be completely invisible. Wave 4 hits closer to home. If you're planning any summer travel, your vacation already costs more. You just haven't checked the prices yet. Jet fuel has surged more than 60%. Fuel accounts for 25 to 33% of airline operating costs. When that jumps 60% in 3 weeks, airlines have 2 options: absorb it and destroy their balance sheet, or pass it through to customers. Analysts are projecting 15 to 30% fare increases for summer 2026 travel. The price you see today is lower than next month. Then there's Wave 5, the one that's going to quietly cost you the most money because it doesn't show up as a line item. It shows up as a number that won't go down. This is the interest rate wave. At the start of 2026, markets were pricing in multiple Federal Reserve rate cuts, lower mortgage rates, cheaper car loans. People were building financial plans around it. That expectation is now functionally dead. Higher oil prices push inflation up while simultaneously dragging down consumer spending. The Fed is trapped. Cut rates and you pour fuel on inflation. Raise rates and you risk a full recession. There's no clean exit. 30-year mortgage rates are stuck at 6.5%. Auto loan rates are around 7%. Average credit card APRs are 24%. If you were waiting for rates to come down to tackle that credit card balance, the relief isn't coming. Gas, groceries, fertilizer, airfare, interest rates. But here's what makes this genuinely dangerous. Your brain is actively working against you right now. When you encounter a complex problem, your mind grabs the most visible data point. Psychologists call this anchoring bias. Right now, that anchor is the number on the gas station sign. Because gas prices feel annoying but survivable, your internal threat assessment files the whole situation under temporary inconvenience. Meanwhile, the IEA is calling this the greatest global energy security challenge in history. This is precisely what happened in 2022. Gas prices spiked, people grumbled, then inflation hit 9%. By the time most people grasped the full scope, the damage to their purchasing power was already done. You're not irrational for missing this. You're running the same mental software as everyone else. But recognizing that is the first step. Let me walk through what happens to households that wait. The gas price spike hits first. They absorb it by spending slightly less elsewhere, maybe skipping one streaming subscription. Then the grocery wave lands. The budget that was already tight gets tighter. The credit card starts carrying a small balance month to month, just temporarily. Then summer travel arrives. The vacation gets charged to the card because the cash isn't there. Then October arrives and food prices jump again. The temporary balance is now a permanent fixture accruing interest at 24%. None of this feels like a disaster while it's happening. It feels like confusion, like somehow everyone else figured something out. But it wasn't luck, it was timing. The households that emerge stronger aren't the ones with the highest incomes. They adjusted earliest. What should you actually do? Here's what works. Your emergency fund needs to exist, and it needs to earn something real. When your laptop needs a $1,200 logic board replacement, having cash is the difference between an inconvenience and a credit card compounding at 24%. High-yield savings accounts are paying 5% APY right now. With the Fed frozen, these rates aren't going anywhere soon. 3 to 6 months of essential expenses: rent, utilities, groceries, insurance. Calculate that number, multiply by 4 to 6. The psychological value of an emergency fund is almost more important than the financial value. You don't make fear-based decisions. If you're carrying high-interest credit card debt, attack it like the emergency it is. Paying off a card charging 24% is mathematically identical to earning a guaranteed 24% return tax-free. You cannot buy that return anywhere. Use the avalanche method. Minimum payments on everything, then throw every extra dollar at the highest interest rate first. Do not panic sell your investments. The S&P 500 dropped nearly 7% from its January peak. Every instinct tells you to move to cash. That instinct is a mistake. 7 of the 10 best trading days over a 20-year period occurred during bear markets. Missing just the 10 best trading days in each decade would turn a 15,000% total return into 91%. Keep your investment contributions running. You automatically buy more shares when prices are low. If you're planning summer travel, book flights today. Every day you wait costs money. Audit your energy exposure. A daily 40-mile drive and a 12-mile-per-gallon heavy-duty pickup, that math just changed materially. Cut discretionary spending before you have to. If you wait until all 5 waves have landed, you'll be scrambling reactively. The households that fare best make small, unglamorous adjustments early. Trimming spending, fortifying savings. There's a scenario that keeps economists worried: stagflation, rising inflation, and slowing economic growth at the same time. If oil approaches $150 per barrel, we're past inconvenience. We're into structural damage to household budgets. Every major oil price shock in the last half-century has been followed by some form of recession. Relief won't be instant. Economists describe the rockets and feathers effect. Prices shoot up like a rocket, but drift down like a feather. The real gap is between people who prepare early and people who don't. Past shocks reveal a consistent pattern. You're watching this video right now. Your window is open. Most people won't think about this until the 5th wave hits.
I'm auditing my expenses right now. No more $15 premium battle passes for me. I'm a financial fortress.
Financial literacy isn't just about budgeting. It's about understanding how the economy actually works so you can see what's coming, how diesel prices become grocery prices, how fertilizer shortages become food inflation. The 5 waves are going to hit everyone. The difference is whether you understood what was happening and responded. Emergency fund, debt attacked, investments maintained, travel booked, discretionary spending trimmed. Panic selling, freezing, pretending it'll blow over, those are the wrong responses for this moment. The right response is quieter. Prepare, adjust, continue, and stop doom scrolling the financial news. You've navigated uncertainty before. You'll navigate this one too. The only question is whether you'll let the disruption make your decisions for you or whether you'll make them.